Hello friends, a very warm welcome to my channel. In this video we are going to talk about a stock in a sunrise sector, which is the water treatment sector, that is Va Tech Wabag. This company has been into limelight for quite some time. The revenues were stagnant and the stock price did not move for a long time. But recently we saw a big rally in this stock because the sector has been discussed quite a lot. The government as well as the private sectors globally have been focusing on this theme of water conservation and treatment. And this company is one of the largest in India in that particular business. So we'll try to cover all the important points in this crisp video. If you're new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos which I upload. And if you're not a part of our Telegram channel, do join today by clicking the link in the description so that you join the correct channel. Every day morning before the market opens, I share my views on the markets and also share strategies to manage your portfolios and increase your returns. So let's begin the analysis of Va Tech Wabag. This will be the flow of our discussion. We'll start by understanding the business model in brief. We'll look at the stock performance in the last few years. We'll discuss the main financial parameters. Then we'll discuss why the stock has given a run up recently. What is the outlook of the management going forward? How are the valuations at present? What are the risks of investing in this company? And by discussing all these things, we'll form a view on the stock. So Va Tech Wabag is a complete water treatment solution provider. So whenever some private company or a municipality wants to set up a water treatment plant, this company gives a complete end-to-end solution to them. In-house, they have developed more than 125 IPs related to this theme. So this company does procurement and engineering. So by procurement, I mean if somebody wants to set up a water treatment plant, whatever equipment is required for that, they are procured by Va Tech Wabag on their behalf, and they also design, install and also maintain the equipment if the client requires. They have an asset-light business model, as and when they require the equipments, they procure based on the client's requirements, and they don't get into the civil construction part that is generally outsourced by this company, which is a part of the entire project which they take up. The company wants to focus on the value-added project because they have higher margins and they don't take up the general works. And in this particular sector, they have more than 100 years presence, so they have a massive experience and they have done projects in more than 25 countries. So why is this company the leader in the space? Because they provide a 360-degree solution to their customers, right from the design, then they procure the equipments, do the construction on their behalf, install the equipments, do the commissioning of all the equipments and testing, and then further they also do the O&M part as and when the client requires. And this they do both for the industries, that is the companies, as well as the municipalities. So you can understand that if they cater to both of these, then the market size is quite huge. So these are the different models in which one can give work to Va Tech Wabag. EPC is a model where engineering, procurement and construction is done by Va Tech Wabag, which we discussed just in the previous slide. Then O&M is post the installation of the project. Design, build and operate is another model wherein they design, build and operate themselves. Build, operate and transfer, where Va Tech Wabag builds, operates and ultimately transfers it to the ultimate owner, which is their customer. And the hybrid annuity model. So these are the different models in which you can work with this company. Now when you talk about the EPC revenue, it forms about 83% and O&M forms about 17% of the revenue. So the majority of revenue from EPC, and the municipal business is the majority of the business, which is about 64%, and the industrial business is just about 36%. From India, they get about half of their revenue and half of the revenue from abroad. So when you look at the chart in the last 5 to 10 years, the stock made a high of somewhere around 1000 earlier, and then onwards it went down into a big consolidation phase and corrected to almost 50-100 rupees from there, because the revenue was quite stagnant and the profits were very volatile and inconsistent. And from then onwards this theme picked up and we started witnessing improvement in the profitability, and the stock started moving as and when the company increase their order book by winning new orders. And right now it is back again to the all-time high zone of around 1000 rupees. So if at all was this consolidation in the range of 1000 rupees, if there is a breakout from here, it will be a fresh breakout into the all-time high zone, which is generally considered very strong in terms of technicals. When you look at the revenue, you will not notice much of change in the revenue in the last few years. In FY20, the revenue was somewhere around 2500 crores, which increased to 2800 crores in FY21. And from there onwards also the revenue is more or less stagnant. So although the order book is growing, one concern with this company is the revenue is not moving and growing consistently every year. So this is something which you have to closely monitor going forward also. When you look at the EBITDA has gone up from about 200 crores in FY20 to almost 366 crores. So this is the reason for rise in the stock price, because although the revenue was stagnant, there was an increase in profitability every year. Margins have shown slight improvements. Earlier they were somewhere around 8% EBITDA level. which increased to almost 13% right now, and the management is confident of maintaining these margins going forward also. The ROE is slightly less of about 14.5%. One big concern in this company is that the promoter holding is only 19%. This is not considered very well when you look at it from an investor's perspective. The second thing which you have to observe in this company is that the working capital management doesn't seem to be very efficient to me. At a 2,000 or 3,000 odd crore revenue, they have debtors of about 2,000 crores and trade payables of almost 1,000 crores. So there are a lot of money is locked in the working capital in this business, which is generally not something which I like, and the working capital should be managed very efficiently. Now, what led to the rise in the stock price is the expansion in profitability because the revenue was constant. The theme clicked in the recent years as the people were looking to invest in companies into this sector, as the government also was sounding very supportive for the companies in this sector. And the order book is quite strong. We'll look at the order book going forward. It's about 11,000 crores of orders in their pipeline. Now, what is the growth outlook of the management going forward? They have done some strategic tie-ups with Peak Sustainability Ventures to establish 100 CBG plants. So they have also moved into the compressed biogas units. They have done another tie-up with a company called Pani Energy to implement AI in their water treatment plants. So they are adopting new technologies in their business. They have also started working on desalination of green H2 plants. And the company has a history of supplying pure water to the semiconductor industry, which is their basic requirement. So as we discussed, the order book is somewhere around 11,400 crores, which is quite huge compared to the present top line of the company. But why the order book is not materializing into the revenue growth is something which I am concerned about. And in spite of such a big order book, the company is guiding for just about 15-20% CAGR growth going forward, which is okay for any other company, but for a company of this size of order book, I feel it is slightly on the lower side. The management is confident of maintaining an EBITDA of about 13 to 15%, and if they are able to do so, I would be quite happy. And they want to focus and increase the O&M revenue to almost 20% of the total revenue. When you look at the valuations, as the revenue did not grow in the last few years, the company was generally given lower multiples, and the last 5 years PE multiple is somewhere around just 13.5. So compared to that, 25 is on the higher side. But if the company is able to maintain the growth which they are guiding for about 15-20% and the EBITDA margin of 13 to 15%, then these multiples of 25 will sustain and they will not prove to be so expensive. What I have observed is because of the lack of execution and uncertainty in the profitability in this company, generally they have got lower multiples compared to the others. Now, what are the risks of investing in this company? I feel that the working capital is not properly managed and that has to be closely monitored going forward. If the money is stuck in the receivables this way, then there could be a cash crunch. The promoter is holding is very less, which is about 19%. And there is and will be competition from other companies going forward. And by execution, what I mean is the order book should get converted in the actual revenue is what I am looking for going forward. So now that we have covered the business model of the company, we've talked about the growth plans, the risks involved, the valuations, the stock performance. What is the view on the stock? If you are holding this company already and we see that the results of the recent quarter were good, going forward the management is giving good growth guidance, so you should continue to hold but closely watch the execution part. If you are somebody who is looking at a fresh entry in the stock, then you should wait for a dip because recently the stock has given a very big rally and the multiples which the company is getting right now is higher compared to the average which it used to get earlier. So it would be better to wait for a small dip to start accumulating the stock. Secondly, you should build a position gradually in such companies because we are a little doubtful about the efficiency of execution of the company. So as and when you observe that every year the growth is coming, the management is achieving what they are guiding for, the revenue is growing, the margins of the company are maintained above 13%. When you see such things happening, then your position should get bigger. So that's a safer approach to take position in such companies. So that's about Va Tech Wabag. I hope you like the crisp analysis. If you like it, hit the like button, subscribe to the channel. If you want me to make videos on your favorite stocks, don't forget to mention the name of the stock in the comment section. I will definitely pick one of those and make the next video. Do join our Telegram channel. Thank you for watching and have a wonderful day.